UK state pensions for expats. Now, if you're living and working abroad, you're not necessarily retired and you're not necessarily thinking about pensions, but you need to. Why do UK expats, when they go to live and work abroad, why do they need to think about what their circumstance is going to be? In the UK, the National Health Service gives a comprehensive range of benefits for expats that are living and working abroad. That includes the NHS, for example. But as soon as you become non-resident, you're not entitled to NHS anymore. Not entirely true, but in theory, as a UK expat, as a UK citizen returning to the UK, you can become resident straight away and qualify again by becoming re-resident. But you have got that grey area in between, which you need to consider for that. But also, by living and working abroad and continuing to pay national insurance in the UK, you're also retaining your entitlement to benefits in the UK. If you're out of the UK for 20, 30 years and you're not paying any social insurance or national insurance in the UK, then clearly you're going to become estranged and not domiciled and remote from the UK, and your entitlement to benefits is going to be limited. However, if you return to the UK, you could potentially get that entitlement again. If you're working on a short-term contract, by definition, expats are on short-term contracts living and working abroad, then you may need to come back to the UK for whatever circumstance and partake of those benefits at some point in the time. So staying a part of the UK system can work for you. If you go to live and work abroad in another country which has its own social insurance scheme and you're living and working there, there's a complication as well. So there you have an entitlement because you're doing that economic activity in that country to pay social insurance in that country, which can then accrue benefits in that country. But you'll have to earn those and they don't automatically come just because you're a resident. Different countries have different schemes. So again, you've got that a payment for that. So if you're working remotely, whether it's a nomad or just working remotely for an employer based in the UK or elsewhere, then for more than 3 months at a time stay, you should be paying social insurance in that country. That might need your employer to set up a branch or to create in a relationship where there's an employer of record to do that social insurance payment in that local jurisdiction. For more information and guidance on remote working for expats and the need for local social insurance registration, contact us at ProACTPartnership.com. We've got one of our usual watchers that's tuned in, so welcome to you, Val. So as a UK expat, then let's consider as a UK expat, let's consider what the scenario is when you go to live and work abroad. If that's a short-term contract, your employer might keep you on employed pay-as-you-earn terms in the UK, in which case you'll keep paying UK national insurance. Some benefits you won't be entitled to when you're going abroad. You could lose entitlement to child benefit, for example. So this is something else to bear in mind. If you start paying social insurance in another country, you might want to reduce your liability to the UK. And that involves potentially an employer of record to pay social insurance in another country to give your family medical and benefits in that new country of residence, or it could evoke a contract working to adjust the amount of social insurance that you pay. Other countries don't have any social insurance system and it's all private, and then you have to organise the medical and benefits system within your contract, and that's something which is a different situation. but it's still a reason that a UK expat might want to retain a connection to the UK. Let's consider a bit more now about what the long-term benefits of national insurance contributions are for expats living and working abroad. One of the benefits from UK national insurance contributions are the UK state pension. Now, after the index-linked rise again, because the UK state pension is an index-linked benefit. So after the index-linked benefit this year, that UK state pension is now over £200 a week, £10,000 a year. That may not be a lot in terms of what your pension or earnings are at the moment, but it's still an entitlement that you could earn. And if you're saving into a pension scheme, this could be deemed to be a good savings scheme to earn an index-linked pension payable after your retirement age for the rest of your life. So the limited in terms of there are no widow's benefits, there's no death benefits. However, if you survive into retirement, there's index-linked pension, which is an additional amount to supplement your retirement earnings. So that is a reason that expats could consider to continue paying national insurance contributions when they're living and working abroad, as well as retaining that option to benefit entitlement in the UK if their family and their circumstance changes. So let's have a look at how that works. First of all, this is a scenario that your employer could be treating you as pay as you earn from the UK and continue to pay national insurance as an employee and employer. That's one scenario that will be taking place in the normal course of events. If that's not your situation, any UK expat that goes to be living and working abroad can elect to pay Class 2 national insurance if they do it when they first go abroad. So if you're going abroad on a short-term contract, you've got the opportunity to sign up for Class 2 contributions to continue paying into national insurance. That Class 2 contribution works out to around about £180 a week. But each year that you pay that, that's a contribution towards your state pension. And for each year, you've got 35 years for that you have to pay into a state pension. So at the moment, with the current rate of the state pension, each year's contribution generates pension worth £300 a year to you. So by paying Class 2 while you're an expat, you're building up an entitlement from £180 contribution a year. That guaranteed return on that saving is £300 in your first year of retirement. But that's only available if you register to pay and maintain payments of Class 2 national insurance contributions in the UK in the early years once you relocate overseas. So as part of your tax registration when leaving the UK, for help and guidance on that, contact us at ProACTPartnership.com. To get a state pension, you need 35 years contributions in the UK. The pension age is under constant revision and it's always subject to increases. So your retirement age could be 66, 67 at the moment, and it may be later on. But then it depends what your life expectancy is. The older you get, the more your life expectancy is. And your life expectancy might be 80. So you could enjoy 10 years of pension payments of, so it means your state pension could be worth 10 times £10,000 a year, which is £100,000. So it can be worthwhile. So the state pension at the moment is £203 a year, index linked. That's £203 a week. That's £10,000 a year, and that's an index linked pension that's payable from your state retirement age until the date of your death. Let's have a look at the scenario where you go to live and work abroad and there is some form of social insurance agreement between the UK and the country in which you're living. in that scenario, if the country where you're living has got a social insurance agreement with the UK, you could pay into that country's social insurance system for 10 years, say, come back to the UK and use that 10 years credit towards your state pension in the UK. And that is entirely possible. But you need to verify that is an option that's open to you, and that it won't be disabled when the time comes. The time that you can't do anything about it is the time that your pension becomes available. In some overseas countries, when you pay into a state pension scheme, such as Cyprus, you may not build up any pension entitlement. You may not qualify for any form of state pension. However, you potentially do qualify for a lump sum that could be paid out in lieu as a one-off payment in lieu of a state pension. So again, it's worth checking out the different schemes and the different ways that they work. In the UK, state pension is only paid out as index-linked income from the date of retirement, but in other jurisdictions, there may be lump sum options or flat rate pension that's available to you, or the contributions from that overseas social insurance or national insurance could be added to your UK contributions to make up a fuller UK state pension. Now let's look at what you need to do to get a full UK state pension. You need to be you need to be paying national insurance in the UK for 35 years to qualify for a full state pension. That could be 10 years from working expat overseas, or it could be 20 years working in the UK and 10 years of voluntary contributions. And it varies depending upon what your circumstance is. If you want to review where you're up to, the UK government have helplines, and you can do a test to see how many years they've got you clocked up for, and therefore how many missing years you've got. But by the time you get to retirement age, you need to have 35 years to get full state pension. If you're a few years short, you could defer state pension for a few years and to add in those extra years. However, there's a limit to the amount that you can catch up. But the things that you can catch up can allow you to get to the 35 years. So for more information and guidance on what you need to do to qualify for full state pension, contact us at proactpartnership.com. The next I want to look at voluntary contribution. So if as an expat, you haven't registered and maintained at least a class 2 contribution while living and working abroad, then you also have a voluntary option. This option is also open to any UK citizen, whether they're expat or not, to enable them to top up missed years of that. So if you've not worked and you've not received an entitlement to a state pension, then you've got this potential benefit later in your life. I'm going to answer your question later, Ram. But so the voluntary contribution needs to be made by anybody who hasn't qualified and got some missed years short of the 35 that they need. If you've got missing years because you've not been working for whatever reason, or not got that credit, or you've been abroad as an expat living and working overseas, then it could be a suitable investment for you to make. However, the voluntary contribution is a different rate to the class 2 contribution for those living and working abroad. The voluntary contribution rate is over £17 a week, which is around about £900 a year. So it's a lot more contribution, but that, again, that £900 contribution generates you £300 a year additional index-linked state pension. So every year that you qualify for state pension at the moment, it's worth £300 a year. So voluntary contribution is a slightly different situation, because to get your money back from your investment of that £900, you need to receive a UK state pension for 3 years to cover that. but that's 3 years of index-linked pension, so it will gradually increase as that's paid. And that index-linked pension will continue to be paid to expats living and working abroad as well. So just bear that in mind, that this can work for you. There are some exceptions, and if you need more help and guidance on your circumstance for the country in which you are tax resident, contact us at ProACTPartnership.com. So voluntary contributions are more expensive, but they allow you to pay that. Now, in the normal course of events, whether you're on voluntary contributions class 3 or class 2 contributions, you can always pay up to 6 missed years. So if you've missed the previous 6 years, you can catch those up, but you can only ever go back 6 years. So if you're an expat returning to the UK, you've been abroad for 6 years, but you've not paid any national insurance, you can go back into the UK, start your work, and then you can make a voluntary contribution for those back years. And again, that will be the 900 a year to catch that up. So you can always pay the current year, which is 23, 24, and the back years for 6 years. So if you're an expat that's going back into the UK, you're coming up to state retirement age, you can pay this year's and 6 other years to give you 7 more years of contributions on the years you've not paid national insurance, pension, state contributions while you've been living and working abroad as an expat. Again, more information and guidance on relocating to the UK and your tax liabilities and benefits, contact us at ProACTPartnership.com. However, one more thing to consider, which includes a group including expats. Many years ago, in the Gordon Brown years, they changed the state pension and went from a more complicated earnings-related state pension to a flat rate pension. So when we talk about the flat rate pension today being over £200 a week, the basic state pension still remains at £156. So the new state pension is quite considerably higher. It's almost £50 a week higher than the basic state pension, which some people will still be receiving, because that is what the entitlement was when they retired. However, people might have had additional SERPs, earnings-related pensions on top of that. So some people might be receiving £300 a week as a state pension. That's a thing of the past. Anybody retiring going forward generally is on the higher rate of state pension at 203. However, as part of that change, to remove entitlement from people to higher earnings-related pensions, there's an extra 10 years of contributions that they can add in, and that 10-year additional catch-up, the right to that ends this year. So in addition to the 6 years of contribution you can add now, any expat living or working abroad could pay another 10 now. So if you've got less than 20 years contribution into a state pension and you're coming up to UK state pension age, you could pay 16 years this year before the 31st of July 23 to top up and get an additional 16 years. You could take your qualifying years from 20 to 35 straight away, and obviously that's almost 50% more. So you could take your UK state pension from 160 to 200 at the current rate, and you would get the money back on that with the additional state pension after 3 years of state pension payments. So it could still be worthwhile a payment. And again, those payments need to be agreed and paid by the end of July. So there's 2 months to run on that. So any expat who wants any guidance on UK state pension and catch up, you need to do that yourself and make those payments. But if you need help and guidance on your tax returns and submissions and advice and support to do that, we're available at ProACTPartnership.com, and you can contact us there for that help and guidance. It's the sort of thing we would give to our retained clients as a matter of course. And if you want to subscribe as a retained client, go to our ProACTPartnership.co.uk site, where you can subscribe from £8 a month for our starter online retained client service, up to a full service at £30 a month, which includes a tax return service as well. So, in summary, expats living and working abroad, UK expats living and working abroad, still qualify for an entitlement to UK state pension. That could still be an index-linked pension, or it may have some restrictions. That depends upon the country in which you're going to. There may be a requirement for you to pay social insurance in the country in which you're in which case you can build up lump sum or benefits or state pension benefits in your new country of tax residence over the long term. But you, as a UK expat, you've still got an entitlement you can build up in the UK. Depends upon the social insurance agreement that is in place between your country of residence and the home country, the UK. For more information and guidance on that, contact us at ProACTPartnership.com. New expats living and working abroad can make contributions to voluntary class 2 contributions because they're living and working abroad. But this is a maximum £180 a week at the moment. And each year that you contribute qualifies you to retain UK state benefits if you return to the UK and get entitlement to a UK state pension, which is worth £200 a week at the moment. So each year that you contribute adds an additional £300 a year to your state pension. For those that have been living and working abroad for some time or returned to the UK or have got missing years, you've got the option for a voluntary contribution, either to be paid monthly and set up and pay over the long term at £17 a week, or £900 a year. But that £900 a year generates you £300 a year's worth of pension, index linked and guaranteed. So after 3 years, you get your money back. So if you have a long and happy retirement, it still remains a good investment and security for you as an individual. Just include widows' pensions, includes entitlement for your income, your benefit the rest of your life. So for more information and guidance on state pension, if you want that additional on your circumstance with your country as an expat living or working abroad, contact us at ProACTPartnership.com. You've got to the 31st of July to make up to 16 years of contributions to top up your UK state pension entitlement. For more information and guidance on that, follow our blogs and our pages at ProACTPartnership.com. Thanks a lot for listening. Join us next week at our webinar, where we look more about tax for expats living and working abroad and how to maximise savings and pensions in those environments. Thanks very much for listening. We'll see you next time.